Hi students, and welcome to the second video on cost of capital. In this video, we'll be looking at taking the various component costs of capital and using this to calculate the weighted average cost of capital. We'll also be looking at WACC breakpoints and looking at how to determine these breakpoints. We are also going to be looking at delevering and relevering a beta and when is this appropriate. Then we'll look at practical issues when using the capital asset pricing model. So far we have looked at the various components making up the cost of capital, that being equity, preference shares, and debt. So these variables will now be brought together, as you can see in this calculation. We need to bring these variables together in order to calculate the WACC. In the example in the slide, you can see that the WACC is derived and this is 13.5%. So what does this rate mean? This is the rate that is to be used when accepting and rejecting investment projects. These projects will be evaluated by comparing the return that the project is going to generate and comparing this to the weighted average cost of capital. As you can see in the slide, the WACC has been calculated using the book values and the market values, and we can use this to compare the two. As you can see, the WACC calculated using book values has resulted in a lower WACC of 13.14%. We would only use book values to determine the weightings in the WACC calculation if the book values are reflective of the company's target capital structure. If we look at the calculation of the WACC using market values, you can see that this is higher at 13.49%. In most cases, it is more appropriate to use market values when calculating your weighted average cost of capital. If a question has communicated to you what the target is, then you will use this when calculating your WACC. If this is not available, then market values are appropriate. And lastly, if the target and market values are not available, then you can assume that the book value is appropriate. So if we look at this example, the WACC using the market values has been calculated as 13.49%. What this means is that the company must earn a return of greater than 13.49% on its investments. Failure to achieve this return will result in a loss of shareholder value. So if a company retains its target capital structure, and if the cost of equity and debt remain constant, then the company's WACC will remain constant. However, what happens when a company needs to raise additional debt and equity finance, and this additional debt and equity finance is at a higher cost? This can happen when a company does not have sufficient retained earnings, and in order to stay within its target capital structure, it is required to issue additional shares to raise the required equity finance. So when new shares are issued, there are going to be flotation costs or issue costs, and this is going to increase the cost of equity. So a company can have various investment projects available to it. If you look at the table in the slide, you can see that the company has a choice of 4 projects. Project A will cost 133 million, Project B will cost 109 million, Project C will cost 48 million, and Project D will cost 30 million. The return per project has also been indicated. If you look at the return per project, you will see that Project D should not be accepted. And the reason for this is that its return of 10% is lower than the company's estimate of WACC. So if we look at Project A, B, and C, the rate of internal return is greater than the WACC of 13.5%. Therefore, it makes sense to accept Project A, B, and C. However, in order to invest in all of these projects, we need 290 million in capital. However, the question tells us in the textbook that the company can invest up to a total of 133 million before the company needs to issue new equity at a higher cost of equity. So the issue of new shares involves flotation costs or issue costs, and this will increase the cost of equity. In our example, they tell us that the cost of equity will increase from 15.2% to 15.5% if new shares are issued. At what point will a company need to issue new shares, which will result in a higher cost of equity? It actually depends on the retained earnings in the company and the weightings of equity in the company's capital structure. The question tells us that the company expects a total retained earnings that can be used to finance projects of 90 million. However, the question we need to ask ourselves is what is the total rand amount of projects we can finance before the cost of capital will increase? The question tells us that for this company, the bank has indicated that it will increase the interest rate to 12.8% if the incremental borrowing for the year increases above 60 million. The question also says that there are no limits on the issue of preference shares. The question we need to ask ourselves is what is the total rand amount of projects we can finance before the cost of capital will increase? Here it is necessary to calculate something called the breakpoints in the WACC. So the formula to calculate the breakpoints is by taking the component funds available and dividing it by the weight in the capital structure. So this breakpoint will show us the total cost of projects we can finance from each source of capital before its cost will increase. So each source of finance will have its own breakpoint. So we will need to calculate the breakpoint for equity, the breakpoint for debt, and because they told us that there is no limit on issuing preference shares, we will not have to calculate the breakpoint for preference shares. So as you can see from the formula, the breakpoint will be based on the available finance and the weighting in the capital structure. So if we apply this formula and calculate the equity breakpoint for this company, we can see that the equity breakpoint is 133 million. This means that the company can invest up to a total of 133 million before the company needs to issue new equity, which will be at a higher cost of equity. They told us in the scenario that the cost of equity will increase from 15.2% to 15.5% for the issue of new shares. So if we look at the cost of debt, the bank has indicated that it will increase the interest rate to 12.8% if the incremental borrowing rate for the year increases above 60 million. So in the WACC calculation, debt has a weighting of 24.79% of the company's capital structure. So the breakpoint for debt has been calculated as 242 million. So the company can invest up to 242 million without incurring a higher interest rate. Therefore, if the company decides to invest above 242 million, the increase in debt obtained will be at a higher interest rate of 12.8% before tax, which works out to 9.22% after tax. So project A, B, and C will be accepted, but the WACC will vary slightly because of the increase in funding needed. So the WACC of the first 133 million investment will be 13.5%. The WACC used to discount the cash flows of project B will be 13.7%. as only the cost of equity has increased. And for project C, the cost of capital will be 13.9%. The textbook shows how these new WACCs have been determined. And like I said previously, project D should not be accepted, as its return of 10% is lower than the company's lowest estimate of WACC. Please have a look at the lecture examples I and J to revise this concept. So up until now, When we have determined the cost of capital, it has been for a company as a whole. However, it is possible that a company may have a number of different sectors or divisions, and these divisions could have different levels of systematic risk. If we look at the beta for BHP Billiton and MTN, you can see that these two companies operate in different sectors, and therefore they have different betas because their systematic risks are different. So it makes sense that if we have a company that has different divisions or different sectors, these sectors will have different systematic risks. So companies that have more than one sector, in other words, they are multi-sectored, they require a cost of equity and WACC to be calculated for each division. So if we think about the company Bidvest, they have various divisions. They have banking divisions, they offer airport services, and also stationery. So each division will require a different cost of equity and WACC, depending on the systematic risk in that sector. So how do we estimate an appropriate sector-specific cost of capital? So when we have a company that has a number of different sectors that have varying levels of systematic risk, when the company is going to evaluate investment, we need to determine an appropriate sector-specific cost of capital. And the reason we need to do this is that we are going to use this cost of capital to evaluate investment projects. So we need to find a comparable company that operates in the same sector as the proposed project. So it is not always easy to find a company that operates in a single sector. However, we need to find a company that comes closest. We then need to make adjustments for varying levels of financial leverage, as the equity beta of the comparable company will include an adjustment for the comparable company's level of financial leverage. So we need to unlever the comparable company's beta to get to the company's asset beta. Then we need to relever the beta to reflect our company's debt-equity ratio. This is also appropriate where a company is considering investing in a new sector which is different to its current sector. So if we look at this example, we have a group called G5. They are a listed construction company and they are considering investing in an iron ore mining company. So what cost of equity and WACC are we going to use to evaluate this investment? Do you agree that the industry in which G5 operates in is different to the industry in which it wants to invest in? So we need to find a similar listed company in the iron ore mining sector. So a similar listed company has been determined to be ArcelorMittal, as they mostly operate in iron ore. ArcelorMittal has a beta of 1.3, a target debt-equity ratio of 150%, and a pre-tax cost of debt of 13%. G5 has a beta of 0.9, a target debt-equity ratio of 100%, and a pre-tax cost of debt of 11%. The risk-free rate has been given to us at 8%, and the market risk premium appropriate in this scenario is 5%. So our starting point is going to be the beta of ArcelorMittal of 1.3%. This is ArcelorMittal's equity beta. It reflects ArcelorMittal's business and financial systematic risk. It is not appropriate for G5 to use this beta of 1.3 to evaluate the iron ore venture because ArcelorMittal has a different financial risk to G5, as can be seen from the differences in the debt-equity ratio. So it is appropriate to unlever ArcelorMittal's equity beta, and this will leave us with the asset beta, which is the unlevered beta. This beta has been unlevered for the financial risk of ArcelorMittal. Therefore, once it has been unlevered, it just reflects the business or sector risk, which is what we want. Then we will relever ArcelorMittal's asset beta to reflect G5's financial risk, and this will give us G5's equity beta, which is the levered beta, which can be used to assess whether we should invest in the new sector. So if we want to put formulas to that, we can use something called the Hamada formula. So this is the Hamada formula we will use when we are unlevering a beta. We will take ArcelorMittal's levered beta being 1.3 and we will divide it, as you can see in the formula, by 1 plus the debt equity ratio of ArcelorMittal net of tax. This will then leave us with ArcelorMittal's asset beta. This asset beta now only reflects the underlying business risk of the iron ore mining company, which is what we want. Once we have ArcelorMittal's asset beta, we now need to relever this asset beta to reflect the financial risk of G5. So now we are going to relever the asset beta to determine the equity beta that G5 can use for their cost of equity calculation. We are going to take the asset beta which we previously calculated of 0.625 and we are going to relever it to take into account the financial risk as reflected by the debt equity ratio of G5. And this is going to give us a relevered equity beta of 1.075. So this equity beta now reflects the business risk of the new sector being iron ore, but it also reflects G5's financial risk. If we were to compare this new beta we have calculated for G5 and compare it to its existing construction beta of 0.9, you can see that iron ore has a greater systematic risk because its beta is higher. Now that we have determined the beta that G5 can use to assess whether it should invest in the iron ore mining company, we can use this to determine the cost of equity based on the information given to us. We were told that the risk-free rate that is appropriate to use is 8%, plus the beta we have calculated being 1.075 multiplied by the market risk premium which was given to us of 5%. This will give us a cost of equity of 13.38%. Now we can use this cost of equity in our WACC calculation that we can then use to evaluate the iron ore venture. So the cost of debt given to us was 11% before tax. So we need to weight this after tax according to the debt equity ratio given to us. The cost of equity we calculated of 13.38% will then be weighted. Once this is done, we will get a weighted average cost of capital of 10.65%. This is the WACC that G5 can use to assess whether it should invest in iron ore mining. So where else is it appropriate to unlever and relever a beta? If we want to determine the cost of equity of an unlisted company, this in the past was difficult. An unlisted company doesn't have a known beta. So what we can do is to find a beta of a similar listed company, and then we can make adjustments to take into account for differences for the lack of marketability, small size, and specific risks that are different between the listed company and the unlisted company. These risk premiums will be added to the cost of equity. Remember, when we were doing valuations, we adjusted the entity or equity value depending on which method we used. It is also possible to unlever and relever betas when there is a significant change in a firm's gearing. If you think about IFRS 16, which is the new lease standard, what will this do to a company's gearing and capital structure? Because all operating leases now need to be treated as finance leases, we are going to see an increase in the proportion of debt financing that a company uses. And because debt is cheaper than equity, overall a company's WACC could decrease. And it would be appropriate to unlever and relever the beta to take into account the change in the firm's capital structure as a result of applying IFRS 16. So when we use the capital asset pricing model, there are some practical issues we need to consider. So if we look at the formula, the first thing we need in the formula is the risk-free rate. But how do we measure the risk-free rate? Are we going to use the market yield on short-term government bonds, like treasury bills, or is it more appropriate to use a long-term bond? So some academics promote using a short-term treasury bill rate, given the assumptions of the capital asset pricing model. However, in practice, companies actually use the long-term bond yield. The reason for this is that it more closely matches the term of the project being evaluated. It makes sense that long-term projects should be evaluated using yields on long-term government bonds. Another reason why short-term rates may not be appropriate is that they are significantly more volatile. So according to a PwC survey, 33% of respondents use the R186 bond as the most popular benchmark as a risk-free rate. Another thing we need to consider is how to determine the market risk premium. What information are we going to use? So the market risk premium is calculated by taking the expected market return less the risk-free rate. So the market risk premium is a forward-looking measure. There are two ways we can determine it. We can use historical premiums based on past data and assume that this is going to reflect what is going to happen in the future, or we could look at surveys of investors and ask them what premiums they expect to earn. According to a PwC survey, a popular source of determining what the return on the market would be is by looking at the all-share index. According to the PwC survey, the average market risk premium was between 5.4% to 6.8%. If the market risk premium is too high, this can actually lead to underinvestment. So if the market risk premium is too high, this will inflate our cost of equity, which will lead to a higher WACC. And if we are using a higher WACC to interrogate profitable investment projects, this can lead to profitable projects being rejected. So a market risk premium of between 5 and 6% is seen to be suitable. So the final thing we need to consider when we look at our capital asset pricing model is what beta to use. We should be using a forward-looking beta, but how do we obtain them? It isn't actually possible, and so we use the historical market returns to estimate a company's beta. But if we are using historical market returns, how far back are we going to go? Should we look at monthly or weekly changes? It makes sense that we won't want to go too far back, as the resulting beta may not be relevant and may no longer reflect the company as it is today. Companies will usually obtain betas from services such as Bloomberg and McGregor. Please have a look at Chapter 4 to look at different industry betas, as these are indicative of different systematic risks. This is the end of the second video on cost of capital. Thank you for watching.